A coordinated attack on Western silver pricing is running right now across 3 simultaneous fronts, and the COMEX April delivery window opens in 18 days with the coverage ratio already sitting inside official stress territory, 6.5 to 1. That is the paper-to-physical ratio on COMEX as of March 4, 2026. 564 million ounces of paper claims against 87 million ounces of registered physical silver, and the clock on the April 1st notice date is not waiting for anyone to catch up. I am going to show you exactly why the coverage ratio at 15.4% is the most dangerous number in this market right now, why China's 44 licensed silver exporters are a structural choke on Western supply chains, why Mexico's Zacatecas corridor collapse is not a headline story but a real supply event, and why the BRICS unit pilot changes the geopolitical pressure on Western paper pricing even at its current early stage. This channel exists because the gap between what CME warehouse reports say and what mainstream financial media covers is where the actual signal lives. Bloomberg covered rate decisions this week. They did not cover a 6.5 to 1 paper leverage ratio sitting 1/2 of 1 percentage point above the official exchange stress threshold 18 days before a major delivery window. That gap is exactly what this channel was built to close. If that is why you are here, drop Legacy OG in the comments, just so I know you are paying attention. The April clock is running whether the cameras are on it or not. There is a number inside the April delivery mechanics that most analysts are not connecting to the China licensing data. I am going to come back to it after we get through the institutional playbook, because without that context it reads as a coincidence. It is not a coincidence. Now let me show you the institutional framework first, because the data only makes sense inside this playbook. Western bullion banks have run concentrated short positions in silver futures large enough to influence spot price for years. The documented mechanism: accumulate short exposure, wait for retail sentiment to turn bullish, dump the spot position hard enough to trigger stop losses across the board, profit on derivatives position for the down move, buy spot back lower, let sentiment recover, repeat. The CFTC has acknowledged concentrated short positioning in silver in past reviews. No active enforcement case is currently open against a named institution. That is important. This is an documented structural pattern, not a current legal allegation. And that playbook depends entirely on one assumption: that nobody demands physical delivery at scale. That assumption is being stress tested in a way it has not been tested in this combination before. The short position running against this setup has a specific structural vulnerability that the banks have not had to face simultaneously. Across supply, geopolitics, and delivery mechanics. I will show you exactly what that vulnerability is after the supply mechanics land. Now here is the COMEX picture in plain numbers. 87 million ounces registered, 564 million ounces of paper open interest. Coverage ratio, 15.4%. The official CME stress threshold sits below 15%. We are sitting 1/2 of 1 percentage point above that line with 18 days to first notice on the April contract. The registered inventory has fallen from approximately 346 million ounces in 2020 to 87 million ounces today. That is a 75% drain over 5 years, while paper claims expanded in the opposite direction. Most people see that ratio and think it is a background statistic. It is not background. At the current 30-day withdrawal pace, the depletion estimate puts COMEX registered silver at approximately 103 trading days before the vault mathematically approaches zero. Here is the number I told you to hold. Pair that 103-day runway with an April delivery window opening in 18 days, and you have an extremely short margin for any delivery demand spike before the coverage ratio breaks through the official stress floor. That is not a theoretical scenario. That is the arithmetic sitting inside the official CME data right now. Look, most people watching this have never had anyone explain what a coverage ratio actually means for them personally. 564 million ounces of paper claims, 87 million ounces of real metal in the vault. If everyone in line tried to claim their chair at the same time, there are only enough chairs for 15. Out of every 100 people standing, the music has not stopped yet, but the number of chairs is shrinking every single day. What comes next is the part that explains who is pulling those chairs out and why. Now connect this to the supply picture underneath it. China implemented a new silver export licensing system on January 1, 2026. Only 44 companies received approved licenses for the 2026 to 2027 window. China controls between 60 and 70% of the world's refined silver supply, restricting that flow to 44 licensed entities is not a logistics adjustment. It is a structural reduction in Western refinery supply with no short-term replacement source. The number looks administrative. The effect is a controlled valve on the dominant share of global refined silver. And the fallback supply from Mexico is compromised in a way that is not being covered accurately. In Zacatecas, which accounts for 33% of Mexico's total annual silver output of approximately 190 million ounces, cartel fragmentation following the February 22 military operation against the Jalisco New Generation cartel has disrupted the transport corridors that move concentrate from mine to port. TD Cowen flagged this directly in analyst coverage. The Vizsla silver worker kidnapping in late January was documented evidence of operational risk at the corridor level. You cannot move silver concentrate to a smelter or port if you cannot secure the roads between them. Some market watchers are circulating claims of a formal coordinated export moratorium declared jointly by Mexico and Peru as force majeure. That claim is unverified. No official government announcement from either country has been confirmed. What is verified is documented production and transport disruption in Mexico driven by security conditions and a fully operational Chinese export restriction already in effect. If you are building an argument, build it on those two confirmed pillars. The unverified moratorium framing is not necessary when the documented reality is already this significant. If you have made it this far, you already understand more about what is actually moving this market than 90% of the people watching silver on financial television. Stay with me, because the BRICS layer is where this story gets structural. My read going into this is that the supply squeeze is structural, not logistical. But there is one piece of the BRICS unit data that either confirms that read or complicates it. Hold that tension while we go through the counter case, because if it reads the way I think it does, the geopolitical pressure on Western paper pricing is not a future risk, it is already present. On October 31, 2025, the International Research Institute for Advanced Systems launched a working pilot of a gold-anchored digital trade settlement instrument called the Unit. 100 units were issued. The reserve basket is 40% physical gold and 60% BRICS national currencies. This is a pilot. It has not replaced the dollar. It is not processing trillions in trade. Anyone framing it as an imminent dollar replacement is overselling it. But here is what the pilot actually signals that matters for the silver setup right now. BRICS member nations collectively increased gold reserves by approximately 129.7 tons in the third quarter of 2025 alone. The unit is designed explicitly to settle trade outside of SWIFT and outside of dollar-denominated systems. That is the stated design, not speculation. When commodity producing nations build infrastructure to price and settle outside Western exchanges, even partially, the paper suppression mechanism that depends on all major producers pricing into dollar-denominated futures loses structural support. The BRICS unit is the blueprint being tested. The 100 units issued today become the template for what scales next. That structural vulnerability I flagged in the manipulation thesis block, the one the banks have not faced in this combination before, is this: paper suppression requires the producer to accept the paper price. When the producer has an alternative settlement infrastructure, even a nascent one, that acceptance is no longer automatic. Now let me show you the honest counter case, because it matters here. The delay argument has real weight. COMEX has survived tight coverage ratios before. The exchange can raise margin requirements before first notice day to force week-longs out before delivery demand materializes. Most futures participants roll contracts and never request physical delivery. Cash settlement protocols exist precisely for stress scenarios. Seeking Alpha's February 2026 analysis argued default probability is effectively zero under current rules, and the mechanics support that argument. The BRICS unit at 100 units issued is not moving global commodity pricing this quarter. The number looks stable. It is not stable. It is frozen, and frozen is worse. Here is the BRICS data I told you to hold. The unit pilot existing at any scale means the architecture for non-dollar commodity settlement is being stress-tested in live conditions. Every quarter it operates without collapsing is a quarter of institutional credibility building behind it. The delay case says the paper mechanism survives. This cycle, the counter-pressure is that every cycle that passes with registered inventory lower, supply more constrained, and alternative settlement infrastructure more operational is a cycle that narrows the margin for the next one. Algos can run the paper game through this delivery window. They cannot manufacture the 150 million ounces of annual supply deficit into existence. Banks can cash settle this April. They cannot cash settle every April indefinitely against a structural physical deficit of over 230 million ounces annually. Here is what to watch. Track the April open interest roll over the next 10 trading days. If open interest does not roll significantly lower before first notice day, delivery demand could test the coverage ratio in a way that moves price sharply. Watch the CME registered inventory daily for any single day drawdown above 2 million ounces. Watch for any official policy statement from Mexico's government on Zacatecas mining security, and watch the BRICS summit agenda under India's 2026 presidency for any interoperability announcement connecting the unit to national payment systems. Verify the data yourself. Pull the CME COMEX warehouse reports at cmegroup.com. Check the daily registered silver figure and the open interest number directly. Cross-reference the 44 licensed Chinese silver exporters through Reuters' coverage of China's January export approval announcement. Read the TD Cowen analyst note on Mexico mining security and the Zacatecas corridor risk. Review the IRIS BRICS unit announcement from October 31, 2025. The ones who actually verify sources realize this is not hype. The ones who do that homework understand what is building here without needing anyone to explain it after the fact. If you are a physical holder, the fundamentals driving your thesis have gotten structurally stronger this week, not weaker. Supply disruptions are compounding across 3 independent sources simultaneously. Hold position. This is not a trading signal. It is a long-term physical scarcity thesis gaining official data confirmation. If you are a futures trader, the April delivery window is immediate event risk. Watch the open interest roll. Know your exit before first notice day if you are long paper into April. The exchange has cash settlement protocols and they will use them under stress. If you are an ETF investor, your exposure tracks paper price, not physical delivery rights. In a delivery squeeze scenario, SLV and similar instruments track whatever the paper market prints. That may capture the move, or it may not capture a physical premium that develops above the paper price. Know what you own. If you are watching from the sidelines, the question is not whether the structure is stressed. The official CME data confirms that it is. The question is timing and trigger. 6.5 to 1 paper leverage, a 75% registered drain over 5 years, Chinese export restrictions fully in effect, and documented supply. Disruption in the world's largest producing region is not a manufactured narrative. It is documented across official exchange data, USGS production figures, and mainstream analyst coverage. Scenario 1, bullish. April delivery demand tests the coverage ratio, open interest does not roll cleanly, and the physical deficit forces price discovery above the paper suppression level, conservative bullish target, silver toward $100 to $150 over the following 2 to 3 contract cycles. Tail scenario. With a genuine delivery squeeze, analysts at multiple institutions project toward $300 per ounce, though that remains a low probability tail outcome. Probability, 35%. Scenario 2, neutral. The April contract rolls normally. Margin increases flush week longs before first notice day. Registered inventory stabilizes as eligible silver converts to registered. China's licensing system creates friction but not a hard cutoff this cycle. Silver trades in a range of $40 to $60 over the next 60 to 90 days. Probability, 45%. Scenario 3, bearish. A coordinated margin increase triggers mass long liquidation before delivery. Paper price drops sharply despite physical tightness. The BRICS unit remains operationally insignificant for the next 12 to 18 months. Silver retraces toward $25 to $30. Probability, 20% everything. Covered here is for educational purposes only. This is not financial advice. Use your own brain. Do your own research. Always, physical will win. The only question is when. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly.